This is an analysis from Alpha Business Media.
Yes.
Welcome to today's deep dive. We know you're here because, well, you have that drive to stay well-informed.
Exactly.
You want to understand not just what is happening in the global business landscape, but the actual structural reasons behind it.
The deeper mechanics of it, really.
Right. You want to stay ahead of the curve. And today, we are looking at a really profound economic paradox that's currently playing out in South Asia.
It's a fascinating situation.
It really is. On one hand, Nepal is experiencing this massive, undeniable wave of digital innovation.
Huge wave.
We're talking about a demographic tsunami of young, digitally native talent. They're building fintech platforms in Kathmandu, agri-tech solutions down in the Terai, and beyond.
The talent pool is undeniably there.
Right. Yet the vast pools of global venture capital that typically rush in to fund such waves, the kind of capital that has entirely transformed neighboring economies like India and Bangladesh, it's just missing.
Completely conspicuous by its absence.
The flow of foreign direct investment into Nepal's most promising startups is essentially just a trickle.
Yes.
So the big question is, why is the money staying away?
It is the defining question for the region's economic future right now.
Yeah.
And to understand why this is happening, we have to look at the fundamental covenant of investment.
The golden rule, basically.
Exactly. For any sophisticated foreign investor, the investment journey does not end when they wire money into a founder's bank account.
That's just day one.
Right, that is only the beginning. The journey truly ends when they can successfully get their initial capital, along with their returns, out of that country.
Makes total sense.
Without a clear, predictable, and efficient path to an exit, there is simply no viable entry.
And that brings us to the single source for our session today. It's an analytical brief titled Startup Policy 2026, 3 Legal Hurdles Blocking Foreign Exit.
It's a really crucial piece of analysis.
Yeah, and the mission of this deep dive is to unpack the 3 critical legal bottlenecks that are effectively choking foreign investment in Nepal right now.
And to explore exactly how the upcoming 2026 policy must surgically fix them, if the country actually wants to build a true knowledge-based economy.
Right. It's a critical document because it moves past the surface-level news reports and gets right into the bureaucratic machinery.
It really gets into the weeds of the friction in the system, which is immense. We are looking at a framework where even if the law says an investor has a right to something,
the actual reality on the ground is totally different.
Exactly. The procedural reality turns that right into an agonizing multi-year ordeal.
Okay, let's unpack this. The first major bottleneck the brief identifies is what we can call the exit room.
The exit room, yeah.
And right away, the source corrects a very common misconception. Because when people talk about foreign investment challenges, they usually focus on how hard it is to repatriate annual dividends.
Which is a headache, sure.
Right. But the brief argues that dividends are not the real nightmare. The actual crisis is the near impossible process of repatriating the principal investment and the capital gains after a company is actually sold.
That's the real trap.
Let's walk through the specific scenario outlined in the text just to understand the gravity of this for you listening.
Sure. So imagine a venture capital firm based in Singapore.
Okay.
They see the potential in Nepal, so they invest $500,000 for a 20% stake in a local e-commerce startup.
A pretty standard early-stage deal.
Exactly. Fast forward 5 years, the startup has done incredibly well, and an Indian retail giant acquires the whole company for $10 million.
Huge win.
Huge win. That Singaporean venture capital firm's 20% stake is now worth $2 million.
Mm-hmm.
It is a massive success story on paper.
Right, on paper.
But to actually get that $2 million out of Nepal, the firm must run a legal and administrative gauntlet that is just staggering.
Wait, so the law actually says they have the right to take the money out, correct?
Technically.
Because if the Foreign Investment and Technology Transfer Act, which the brief refers to as FITA, gives them the green light, where is the bottleneck actually happening?
The bottleneck is completely in the implementation. Legally, the door is open. But practically, that door is guarded by the Central Bank of Nepal.
Ah, the central bank.
Right. The implementation, which is governed by central bank directives, transforms a statutory legal right into a highly discretionary privilege.
So it's not a guarantee anymore.
Not at all. First, the foreign seller has to execute the share transfer and pay capital gains tax to the National Tax Authority.
The Inland Revenue Department.
Yes. And once that is done, they cannot just wire the funds.
Like you would in most modern markets.
Exactly. They have to compile a massive physical dossier for the central bank, We are talking about the original foreign direct investment approvals from years ago.
Digging up ancient paperwork.
Yeah, both the entry and exit share purchase agreements, audited company financials spanning the entire life of the investment,
Wow.
tax clearance certificates, and crucially, a highly complex valuation report justifying the final sale price.
And the central bank looks at all of this.
They scrutinize every single page.
But the really chilling detail for investors here is the timeline, isn't it?
Oh, absolutely.
Because the brief highlights that there are 0 statutory timelines for this approval process.
None. It can take 6 months or it can take several years.
And the regulators can constantly request additional, often redundant documentation.
It's a moving target.
Right. And for a listener familiar with the venture capital model, you know that unbounded uncertainty is absolute poison.
It breaks the whole machine.
Because venture funds operate on strict life cycles, usually 7 to 10 years.
Right.
They raise money from their own limited partners, they invest it, and they need to recycle that capital from successful exits into new ventures or return it to their backers.
And if that capital is locked in bureaucratic limbo for years, Nepal essentially becomes a capital trap.
Yeah.
The business model of venture capital mathematically breaks down if the exit window is an indefinite question mark.
It just doesn't work.
What is fascinating here is the historical context the brief provides to explain this regulatory behavior.
Because they're not just being difficult for the fun of it.
No, the system is not necessarily malicious, it is just anachronistic. Nepal's legal framework and institutional mindset were designed for 1980s-style industrial investment.
Old school, heavy industry.
You think of massive infrastructure projects like cement factories or hydropower plants.
Right.
In those industries, capital is extremely patient. Exits or complete buyouts are incredibly rare, and the physical assets cannot easily be moved.
You can't put a cement factory in your carry-on.
Exactly. So the regulatory DNA is built to be deeply suspicious of large sums of money suddenly leaving the country.
They view it as a crisis.
Right. They view it through the lens of potential capital flight, rather than the successful natural culmination of a risk-based technology investment.
It sounds like they're treating a high-velocity tech investor the same way they would treat someone trying to dismantle an entire hydro dam and smuggle it out of the country in their suitcase.
That is exactly what it feels like. They are fundamentally misaligned with the reality of modern capital mobility.
So what's the fix?
The brief makes it clear that until there is a streamlined, predictable mechanism, it specifically suggests a 45-day automatic approval mechanism for registered venture funds to repatriate capital gains.
45 days. Guaranteed.
Yes, guaranteed. Until that happens, foreign investors will simply look at other emerging markets.
Okay, so we have established that the investors are effectively trapped. But what about the people actually building the product?
The founders and the team.
Right. If the venture capital money is stuck in limbo, how do you even attract the talent to build a company worth investing in to begin with?
That is the second major hurdle.
Yeah, that brings us to a massive blind spot in Nepali law, which the brief calls the ESOP enigma. Now, anyone who follows global business knows ESOPs, employee stock ownership plans, are the secret weapon for hiring.
They're the bedrock of Silicon Valley.
Why is this such a roadblock in Nepal?
Because in the global war for talent, ESOPs align incentives perfectly. When a startup cannot pay a massive corporate cash salary, they offer equity.
A piece of the pie.
Right. They give employees the right to buy stock at a lower fixed price in the future, turning them from mere wage earners into vested partners.
The employee works hard to grow the company's valuation because they own a piece of it.
But in Nepal, as the source describes it, ESOPs are a legal phantom. They exist in a complete legal vacuum.
A phantom? Meaning the law just doesn't see them.
The foundational corporate law, enacted back in 2006, makes absolutely no explicit mention of stock options.
Nothing at all.
It understands the direct issuance of shares today, but the concept of a future right to buy shares based on a vesting schedule is completely alien to the legislation.
And in global tech, you usually see something like a 4-year vest with a 1-year cliff.
Very standard.
Let's break that down for a listener who might not deal with startup compensation structures every day. What does a 1-year cliff look like in practice, and why does the lack of legal recognition matter so much?
Think of a 1-year cliff like a trial period. An employee is promised a certain amount of shares over 4 years, but they don't get anything until they hit their first work anniversary.
So if they leave at month 11, they walk away with 0 shares.
Exactly. It protects the founders from giving away company ownership to someone who doesn't stick around.
Makes sense.
But because Nepali law doesn't recognize this conditional vesting mechanism, an employee could theoretically try to legally claim a chunk of the company on day 2.
Oh, wow.
Or conversely, the founders could just refuse to honor the agreement entirely.
Because it's not legally binding.
It makes these multi-million-dollar equity packages legally unenforceable. They're effectively gentlemen's agreements.
Here's where it gets really interesting. And honestly, it sounds like an absolute nightmare for the employee. It is the tax ambiguity.
The tax side is terrifying.
Right, because the legal framework does not exist. How does the Inland Revenue Department handle this paper wealth?
Well, the tax authority has not provided any clear guidelines on how to treat these options.
So it's just a guessing game.
So the critical question becomes, when is the taxable event? The brief points out a disastrous potential scenario.
What happened?
Tax authority might decide to levy an income tax when the employee simply exercises the option to buy the shares, taxing them on what is called the perquisite value.
And perquisite value is?
That is the difference between the current high market price of the stock and the much lower price the employee was promised years ago.
Okay, let's translate that. Imagine winning a luxury car on a game show, but the rules say you aren't allowed to sell it for 5 years.
Good analogy.
Yet, the government demands $20,000 in cash for the income taxes today.
Yes.
You have a valuable asset on paper, but you are legally prevented from turning it into the cash you need to pay the tax bill.
That is the perfect way to look at it. You are asking an employee to pay real-world cash income taxes on illiquid paper wealth.
That's crazy.
They hold stock in a private company that they cannot easily sell. It has no immediate liquid value, yet the government demands cash for the privilege of holding it.
It is an untenable situation.
Completely.
Tying this back to the broader business strategy, think about the impact this has on a Nepali startup trying to build a world-class team.
It cripples them.
They are competing with massive tech hubs like Bangalore, Dubai, or Singapore. They want to bring experienced Nepali engineers and managers back home.
But those professionals expect legally sound, tax-advantaged equity as part of their compensation.
Of course they do. And because Nepali startups cannot offer that safely, they are forced to compete entirely on cash.
Which they don't have.
Right. They have to burn through whatever precious runway they have paying inflated salaries, which severely handicaps their chances of long-term survival.
The brief states that a direct amendment to the Companies Act to explicitly define stock options and create a favorable tax regime.
Specifically, taxing the gains only upon final sale as capital gains.
Right. That is not just a nice-to-have feature for the 2026 policy. It is an existential necessity. If founders cannot compensate their teams with equity, the ecosystem cannot scale.
Which leads us to an unavoidable problem. If startups cannot use equity to hire, they desperately need cash.
Cash is king.
But getting early-stage cash brings us to the third hurdle, which the brief aptly names the Great Wall.
This is perhaps the most immediate barrier for early-stage founders.
It really is. It comes down to a single line item in the foreign investment policy that mandates a minimum investment floor.
Just one line.
It requires any single foreign investor to bring in a minimum of 20 million Nepali rupees.
Which translates to roughly 150,000 US dollars.
Why is setting a minimum floor like that so destructive for innovation?
To understand the damage, we have to look at the reality of the startup lifecycle. Innovation does not start with a multi-million-dollar check.
Rarely ever.
It starts small and grows in stages. A founder might raise a pre-seed round of $25,000 to $50,000 just to rent server space, build a basic prototype, and test the market.
Just to get the lights on.
Exactly. Then, maybe an angel round of $100,000 to $250,000.
But that money usually comes from a syndicate of multiple smaller investors writing $25,000 checks, not one person writing a single massive check.
Right.
So because of this NPR 20 million floor, it is legally impossible for an early-stage investor in the United States to write a $50,000 check to a promising Nepali health tech app.
It drops them straight into a valley of death. The policy actively forces startups to seek massive checks that are completely misaligned with their early-stage valuations and their actual capital needs.
Because a company valued at $500,000 cannot give away $150,000 of equity to a single investor without the founders losing control of their own company immediately.
They would be giving away too much of the company. They are too big to survive on local informal funding from friends and family, but they are legally blocked from accepting the foreign direct investment that wants to back them at the right scale.
But entrepreneurs, by their nature, are problem solvers.
They will always find a way.
If a wall is built, they will find a way around it. And the brief introduces a massive workaround that founders are practically forced to use. It is called the Singapore flip.
The Singapore flip.
How does this maneuver actually work?
It's a structural reorganization. The Nepali founders will go to a jurisdiction with a favorable, modern legal climate. Singapore and Delaware in the United States are the most common, and they establish a brand new parent company there.
Okay, so the main company is now offshore.
Yes. Then they make their actual operating company in Nepal a wholly owned subsidiary of that new foreign entity.
I see.
Now, when foreign investors want to fund the startup, they do not invest in Nepal at all. They invest freely into the Singaporean parent company, entirely bypassing Nepal's minimum thresholds and capital repatriation nightmares.
So what does this all mean for Nepal's economy? Because on the surface, the company gets funded, they lease an office in Kathmandu, and they hire local developers.
Looks like a win.
But underneath, the brief points out a profound economic tragedy.
It means Nepal is effectively outsourcing its own wealth creation.
How so?
To understand why, we have to look at the cap table. The cap table is basically the master ledger that dictates who owns what percentage of the company.
Right.
In the scenario of a Singapore flip, that master ledger does not live in Kathmandu. It lives in Singapore.
The ownership is entirely foreign.
The intellectual property is registered to the Singaporean parent. Legal control of the board of directors happens under Singaporean corporate law.
And the taxes.
That's the biggest loss. When that startup is eventually acquired for millions of dollars, the massive capital gains taxes are governed by the jurisdiction where the parent company sits.
So Singapore gets the tax revenue.
Yes. Nepal bears all the risk of nurturing the startup, educating the founders, and providing the initial test market, but reaps almost none of the ultimate sovereign rewards.
The brief contrasts this sharply with regional competitors, doesn't it? It shows how far behind this policy is leaving the local ecosystem.
Bangladesh, recognizing this exact dynamic, has completely abolished minimum foreign direct investment thresholds for its IT sector.
Completely gone.
And India has no such floor for technology investments either. They're rolling out the red carpet for early-stage angel investors, removing the friction so capital can flow easily.
Meanwhile, Nepal is actively maintaining a wall that exports its most promising future enterprises.
The recommendation here is definitive. The 2026 policy must advocate for the complete removal of this threshold for registered startups, or at least create a specific startup FDI category with no minimum floor at all.
That brings us to the conclusion of the brief and the crossroads Nepal faces with the upcoming Startup Policy 2026.
It's a critical juncture.
The source synthesizes all of this analysis into two distinct strategic outlooks, representing two very different possible futures for the country's innovation economy.
Let's look at the first option.
Yes.
The first future outlined is the scenario of stagnation.
Sounds bleak.
This happens if the 2026 policy ends up being just a document full of aspirational language, but fails to trigger actual hard legislative amendments to the foundational laws.
So all talk, no action.
Exactly. In this scenario, the minimum investment floor remains. Employee stock options stay a legal phantom, leaving workers with unenforceable contracts and tax nightmares.
And the exit room.
Capital repatriation remains a discretionary, multi-year ordeal controlled by the central bank.
So nothing changes.
The result will look like success on the surface, a cosmetic boom.
That's cosmetic.
Nepali founders will continue to build great products, but the Singapore flip will simply become the permanent standard operating procedure.
And the core economic value will be captured by more sophisticated foreign jurisdictions.
Nepal will supply the raw coding talent, but it will not own the enterprise. It becomes a back-office economy servicing wealth generated elsewhere.
But there is the second future, what the brief calls the scenario of surgical reform.
The much better path.
This is where the 2026 policy acts as a real legislative catalyst. What are the specific actions required to make this scenario a reality?
It triggers three very targeted actions. Number one, the foreign investment law is amended to create a zero minimum startup FDI category, allowing pre-seed and angel capital to flow in legally.
Okay.
Number two, the Companies Act gets a dedicated modern chapter on ESOPs, defining vesting schedules and creating a predictable deferred tax framework.
Solving the talent issue.
And number three, The central bank issues binding directives guaranteeing a 45-day automatic approval process for the repatriation of capital gains.
Fixing the exit room.
Exactly.
Yeah.
The second scenario is the only path that actually domesticates capital. It encourages onshore innovation and builds a resilient, taxable economic base that benefits the country itself, not just offshore holding companies.
It is a stark choice between those two futures. And the final takeaway for you, the listener, regardless of where in the world you live, work, or invest, is a timeless lesson in modern economics.
It really applies everywhere.
In the 21st century, capital and talent are incredibly fluid. They are highly mobile assets.
They go where they're treated best.
Exactly. They do not flow to where they are trapped by bureaucracy or punished by ambiguous tax codes. They flow to where they are treated best, where they are understood, and where their rapid growth is facilitated.
So true.
The real challenge for Nepal's leadership isn't just sitting down and drafting new, elegant rules on a piece of paper.
That's the easy part.
Right. It is cultivating the regulatory courage required to overcome a 50-year legacy of capital control paranoia.
And this raises a really important question, something that Breeze touches on profoundly at the very end.
What's that?
The sources mention that this immense regulatory friction in Nepal is not an accident or an oversight. It is described as a feature, not a bug, born from decades of deep-seated institutional paranoia regarding foreign exchange and capital flight.
A feature, not a bug.
Right.
Right.
It leaves us with a compelling thought to mull over. When a government's entire bureaucratic DNA is hardwired to act as a suspicious gatekeeper, what does it actually take to retrain an entire generation of civil servants to act as facilitators instead?
That is a massive behavioral shift.
Can you actually legislate a change in human psychology and institutional culture, or does that require a generational shift?
That is the multi-million-dollar question, because it is not just about changing the text of the law. It is about changing the mindset of the people executing the law every single day.
Absolutely.
It has been a fascinating look into the mechanics of global investment, regulatory frameworks, and the realities of emerging markets. Thank you for joining us for this deep dive. We will see you next time.